Imagine the government cranking up taxes, but instead of more cash, the tills go quiet. Why does that happen in plain terms? Economists call this the Laffer curve, a simple curve that claims there's a tax sweet spot before revenue falls off a cliff. In 1974, Arthur Laffer sketched it on a napkin quickly to prove a point: policy can create perverse incentives. Think of extremes: 0% tax brings no revenue, 100% collapses work incentives, and again yields zero revenue. The key is behavior. People adjust work, hide income, invest less. Taxes are a system input that changes output dramatically. Like a factory, raise the load, machines stall, output drops. Tax hikes can overload the economy and slow the whole line. How steep that drop is depends on elasticity, basically how sensitive people are to tax changes and how fast they respond. In the 1980s, Reagan cut top rates, promising growth. Supporters said revenue held, critics blamed rising deficits and mixed outcomes. Kennedy's 1964 cuts preceded a boom. Some credit tax policy, others point to technology, demographics, global trends, and other factors. Real-world data doesn't give a neat curve. Multiple knobs move at once: monetary policy, trade, innovation, and luck. Politicians weaponize the Laffer line, promise tax cuts will pay for themselves. That's seductive, but not always honest or realistic. Investigative beat, ask who benefits. High earners and corporations often gain the most from rate cuts. That's a power story. Taxes trigger avoidance. Accountants reroute income, investors change portfolios, workers choose leisure. The tax base shrinks in messy ways quickly. You can't pinpoint the exact tipping point. Economies adapt. Estimates vary wildly across countries, eras, tax designs, and methodologies too. Some studies find moderate rate cuts raise revenue in certain ranges. Others show little or no revenue payoff at all. Even if revenue doesn't fall, who pays changes. Cuts often tilt benefits to the wealthy, altering inequality and politics fast. This isn't academic. Tax choices fund hospitals, schools, safety nets. Bad calculations hurt real people every day globally right now. High taxes can push economic activity underground. Black markets grow, enforcement costs surge, and social trust erodes, often very quickly. Design matters. Exemptions, credits, and enforcement change incentives. A blunt rate hike isn't the same as targeted reform at all. Governments can widen the tax base, close loopholes, and improve collection. Smarter policy can raise revenue without crushing growth often. Good policy requires experiments and data. Trial small changes, measure behavior, adjust. Think of taxes as programmable settings now. It takes courage to admit uncertainty. Policymakers must balance ideology, evidence, and the messy reality of human incentives too. Voters deserve clarity. If a tax plan risks services, citizens should know the trade-offs and alternatives on the table today. Look at cities that hiked income taxes. Some saw short-term gains, then capital flight and long debates over reversing course. The Laffer curve is a tool, not an answer. Use it thoughtfully, alongside fairness, efficiency, and long-term growth goals always. Taxes are levers. Pull hard without feedback and the system snaps. Smart policy reads the signals and adjusts in real time. So next time a politician promises free lunch via tax cuts, ask for evidence. Who's paying? Where's the data? What's the plan? If you want hard questions and clear explanations on policy puzzles, subscribe. We'll dig into the numbers and the human stories.